Hello, and welcome to this edition of Community Candor entitled Retirement. In partnership with Show Me the Money Day, which is an annual statewide event that kicks off tax season and is designed to connect financial education and resources to the community. We are excited to be here with you today to cover this topic on retirement. My name is Renee Kent. I'm the Director of Special Projects here at Communities First, your host. And we have a special guest from Comerica, who is also sponsoring this series through the Comerica Bank Money Sense series. So we are excited to have Kevin with us, and we'll get him introduced in just a moment. But just wanted to share a little bit about Communities First, your host. We are a nonprofit organization going into our 15th year, and our mission is to build healthy, vibrant communities through economic development, affordable housing, and innovative programming. And so we're very excited to, yes, please check us out on our social media platforms. We have a ton of activities and programming going on all the time. But we're very excited to be here today and to offer this information online, virtually, as well as some of the in-person sessions that we offer as well. Please note that to do this, we need your feedback. So throughout this presentation, we will be displaying a link for a survey. Please fill the survey out. It lets us know how this information is helpful to you, but also if there are other topics that you would like us to cover. And additionally, if you fill the survey out, there is an additional toolkit that Comerica has provided that goes along with this session that will be super helpful in your planning for retirement. So fill the survey out. We'll have your email information and we can get that to you. And we'll be sharing that throughout the presentation just in case you missed it. So I'd like to welcome Kevin. Thank you for joining us, and just give you an opportunity to introduce yourself to the audience.
Absolutely. Absolutely. Thank you so much, Renee. My name is Kevin Watkins. I am the External Affairs Manager at Comerica Bank, and I'm also our National African American Business Development Manager. In my External Affairs Manager role, I essentially manage all of our relationships with our nonprofit community partners, specifically in regards to our philanthropic endeavors when it comes to funding as well as volunteerism. And that funding and that volunteerism is specifically tied to CRA, which is the Community Reinvestment Act. So we look for organizations that have a focus in financial education, career and workforce development, affordable housing, and health and human services. So I know there are several of those areas that Communities First has a focus in. So, we are proud partners, and we're glad to be here.
We're glad to have you.
Yes. Yes.
So just to kick this session off, we know that in the communities that we serve, and even amongst our colleagues and people that we know, there are more questions than not about finances. We just did a session recently on home ownership. Today we're talking about retirement. And we know oftentimes it's uncomfortable, depending on what your financial situation is, to go to a professional and ask the questions that you have. So I want to share this bit of information. Many individuals feel like they're behind on their retirement savings and are even worried about their ability to retire. In 2022, a survey of consumer finances showed that nearly half of American households have no retirement savings. So oftentimes we feel like maybe we haven't done exactly everything that we're supposed to, or we don't know exactly what we're supposed to do. And because of that, it it makes us uncomfortable in reaching out to those professionals. And so this platform, I hope, will help provide some information and resources, but also show that it's okay, no matter where you are in the process,
Mhm.
to talk to someone who may be able to assist you. And so we're going to talk about, how to get started, where to get started, um, and then also through some of the dialogue along the way, talk about what resources are out there that you should tap into. So I'm going to stop talking. Let's go ahead and get that presentation queued up. And then we'll turn it over to Kevin, who will kick us off on this journey
Mhm.
to preparing for retirement.
Absolutely. Absolutely. All right, there it is. Perfect. So I believe Renee, she really kicked us off in the very best way. She painted that picture of so many households, half of all households that really don't have anything saved up for retirement, unfortunately. And even if you haven't started, just like she said, we're going to go over different scenarios, different options that you may have, who the best people are to talk to, and just a few things to hopefully set your mind at ease and really get you on the right track to retirement if you aren't already, or just to solidify the fact that you are on the right track. So I think a lot of this comes down to comfortability. So I truly recommend that you work with a partner organization, a bank, financial institution, brokerage firm. Uh, Go where you feel welcomed and where you understand that the individuals that work there, they have a particular level of knowledge to where they're going to be able to give you their very best. So you really want to work with dedicated professionals. You want to be, you want your opinion to matter. So when you are looking for organizations to work with, those are just a few factors that I would definitely suggest. So let's get right into it. And these are just a few of the goals that we have for this particular session. So we are going to examine the factors you should consider when planning for retirement, how to estimate your retirement expenses. We'll be able to identify the saving and planning strategies that allow you to maximize your savings at any age, compare the types of retirement plans available to you, and then also set goals for your own retirement savings. So those are all of the different activities that we will focus on for today. All right, so I'm going to call on Renee in this particular exercise. So I just wanted to ask you a few questions to see where you're at with your retirement journey. So, and these are yes or no questions. So, Renee, have you started saving for retirement?
I have started saving for retirement. And
Perfect.
I do fit in that category where I don't feel like I've done enough. And I'm okay saying that because I don't think I'm alone.
That's true. That's very true. There are times when I feel the same way. So yeah, there's nothing wrong with that. But the important thing is that you've started, because you're really so far ahead of a lot of other people that they haven't even started. So you're on the right track for sure. Have you thought about a retirement plan?
I have, and I'll just throw this out there really quick. Um, there is no wrong age to get started. You know,
True.
it's ideal if you start like early on when you first start out your career. But things happen, right? And maybe you're now on your second career, or you're nearing retirement and you're starting to think about it. There's no wrong time to get started. Um,
Mhm.
it's certainly ideal to get started as early as possible, but there's no wrong time.
Absolutely. Totally agreed. Totally agreed. I used to have an employee that worked for me, and she was maybe in her mid 30s, and she was talking to me about retirement. she was already, she already had set in her mind when she was going to retire. She did the calculations. So it's never too early, it's never too late. Really, the most important thing is just to get started. That's the most important factor.
Absolutely.
um, yeah. So have you already enrolled in a retirement savings plan, either through your employer or on your own?
I have, and I will say it's really easy. The resources that my employer offers, and I'll just speak for a lot of different plans that are out there through employers. If if you have questions about it, typically um, there's somebody within your HR team or somebody with the plan that's connected to whatever your employer is offering, and it's their job to help you understand it. If you have questions like how to set it up, what's the best strategy based on when you want to retire, how do you diversify, which I'm sure we're going to get into later. But if you're fearful of doing it because you don't want to do it the wrong way, just ask. Don't delay that process because you're unsure of how it works. Ask those questions. That's what those people are in place for.
Excellent. That's excellent advice. Excellent advice. And then last but not least, do you know what's in your retirement accounts?
For me, I check on it pretty regularly, and I try to make sure that it's very well diversified. So no matter what's going on in the economy, um, it the accounts aren't as greatly impacted as if I had everything, all my eggs in one basket, let's say.
That's
And
true.
then I'll just throw this out there really quick when we're talking about, when should you start? Um, if you have children, talk to them and they're working, talk to them about getting started in doing that. I have a high school student who is saving for retirement. Um, Now, mind you, of my four kids, he's the only one who listened. But it's never too early. It's never too late, but it's never too early. So have those conversations in the household as well.
True. Absolutely. I will say 1 out of 4 is better than 0 out of 4. So that's a feather in your cap for sure.
Absolutely.
One another thing that I like to add too is something that I did that I kind of regret. I had a job earlier when I was in college, and it was a 401k, so I was able to save up some funds. But then I changed jobs, and then when I changed jobs, something came up. I had to use that money, but in hindsight, I wish that I would have rolled that over into an IRA, individual retirement account, and then save that for my retirement as well. So those are just extra funds. So if you find yourself where you are changing jobs, you know, please use those funds as a very very last resort, because they are essentially supposed to be used for your retirement. If you do use those funds, you're going to have to pay taxes on that. You're going to have to add that as earned income, right? So you pay taxes on it. And then if you withdraw before the age of 59 and a half, you have to pay an additional 10% tax penalty. So those are just some rules and regulations around how those accounts are governed. And hopefully that's something that you can just save until you actually need it for retirement. So that's just something else I wanted to add. All right, so let's go to the next slide here. So of course, whenever you are in retirement planning, it's not too late to develop or refine your saving strategy. So there are going to be some factors that you have to keep in mind when you decide how much that you need to save. So when you look at these particular factors, you take a look at your income, right? The amount of money, the all your current sources of income, salary, tips, benefits, assets. You also want to think about your future and current expenses. A lot of people's most or their highest expense that they have is their mortgage. So you want to think about, is that going to be an expense that you will have in retirement, or will your mortgage be paid off? So that'll be less that you will actually have to need on a monthly basis, right? So that's just something that you'll want to think about as well. You can also think about your health, what's your current health, um, and then also what what you may need to plan for in the future as well. You think about long-term care expenses as well. That's something else that a lot of individuals, they haven't thought about. But long-term care, there are some different options that are available. It could be used as like a rider on some life insurance products, and it may not be that expensive. You also want to think about your taxes as well. Is a pre-tax or a post-tax deduction plan going to be best for you? So there are where you traditional IRAs and 401ks, and then similar vehicles at at schools, at hospitals, where you add funds that are pre-tax, so you don't pay taxes on that money until you withdraw it, which is supposed to be later in life. And then there are Roth IRAs, Roth individual retirement accounts, where you put the funds in and the funds have already been taxed. So then when you withdraw from it, you don't have to pay taxes on the principal funds that you submit. So those are just a few different things that you want to think about. So we'll go to the next slide here. All right. So here's a few additional questions to ask yourself about retirement. So when do you expect to retire? How long do you want your retirement to last? What is your income? And then how much should you save each year? So a good retirement plan is also going to allow you to plan for unforeseen expenses, deal with changes in living situations or health, and remain independent in your later years. So these are definitely some good questions that you want to consider and really want to focus on as you are creating that retirement plan. All right, so let's go to the next slide here. All right, so another important factor you'll have to figure out is how much money you're going to need during the retirement years. So first, you want to determine how long you will likely be retired. So this estimate, it requires thinking about when you will likely retire and your life expectancy. So you might think about how long family members typically live. You want to use a national average, which is currently about 85, or you can play it safe and estimate on the high side, like, say you're going to live until 100. Then you'll have to figure out how much money you will need each year to live securely. Everyone's different, but a good rule of thumb is to aim to have at least 70% of your current income available to you in each year of retirement. So for example, if you make $30,000 a year, you should try to have at least $21,000 available per year during retirement. So that's definitely going to be a best practice for you. All right, so on this next slide, so we are going to go specifically to our participant guide. So this is going to be something that you will share, or you will sign up for additional information, and you'll get access to the participant guide. And this exercise is really going to be helpful in setting your goals. So estimating your longevity. At what age do you expect to retire? How many years will your retirement last? And then your income analysis. What is your current income per year? And then when you use those particular rules, you will estimate the total cost. So Renee, have you ever done an exercise like this as far as setting your goals in retirement?
Yeah, so what I will share is um, on the plan that I have through my employer, um, but also these tools you can find. I think you shared the resource yesterday, Kevin, Bankrate. There
Yeah.
are tons of calculators out there that'll help you kind of estimate, you know, when you want to retire, how long you're going to be in retirement, what your current income is, um, how much you think you'll need to live off of, what
Mhm.
are your expenses going to look like during retirement. Um, a lot of times they'll calculate in, inflation. Um, you have to take that into consideration, right? Because things increase in cost. And they'll let you play around with those numbers so you can see kind of like real time, you know, um, how much you should be setting aside to prepare for, the different scenarios. So I definitely would recommend um, playing with those calculators. And then, of course, as Kevin mentioned, when you fill out the survey, we'll get this resource guide to you so you can complete the information.
Perfect. Perfect. Thank you so much for that. So next we're going to talk about time. All right. So when you think about the value of time, that's going to be one of the most important elements to understand. So I know a lot of this conversation is morbid, right? When you think about how long are you going to live in retirement, but it's something that we have to do. If you don't plan, you're essentially planning to fail. So when you consider time, when you if you start early, the earlier you start, once you start to accumulate some interest on your money or earnings, now you have additional earnings on which you can earn more interest or additional earnings, and it's not just that principal amount that you put in. So in this particular example, let's say you start at $50,000. If you start at $50,000 at age 18 or age 28 or age 38 or age 48, it's going to look dramatically different by the time you retire, right? So, as it says here, if you start at an early age, you're going to earn more over time. If you do, if you do, if you do start late, you may need to save more per month in order to make up that particular difference, right? So a few reasons that some people start saving early in life. Savings was encouraged by their parents. You think about Renee's example. She told all four of her children, but one of them listened, and so he started off at a very early age. So when you look at this particular slide in this chart, his trajectory is going to look like this. Hopefully, her other children get on board. I think about my children as well. I have three, and as I'm thinking about the three, I don't know which ones will listen to me. Hopefully, all three, but I know that's not the case many times. So, the earlier they start, the higher their trajectory of having sizable savings accumulated by the time they reach retirement age. Also, a few other reasons that people start saving early in life. They could have also enrolled in their company retirement program early in their career. And then once again, if your job or your company that you work for, if they offer a match to their particular retirement plan, please take advantage of that match at least, because if you don't, you are leaving free money on the table. Now, we realize that, you won't be able to use it until at least the age of 59 and a half or until you retire. But that's really just going to set you up for a much easier time in retirement. And hopefully you won't have to go back to the workforce and be stressed about money. And then also, understanding the value of starting early. That's going to be a few reasons some people start early in life as well. So a few reasons some people start waiting until they're older. They don't know how to start saving for retirement. They think they can't afford to set money aside for retirement. They're not offered a retirement plan option through work. They choose to spend their money on other things, and or they don't know the value of starting early. So anyone that is able to take advantage of these opportunities, they truly should. All right. And then how can people catch up if they start saving later in life? So, of course, you might have to save more on a regular basis, and then also trying to increase your income as well so you can have more set aside. All right. So, In this particular example, in this slide, so the person's goal is to retire at the age of 67 with at least $600,000. So if the person's goal is to retire at the age of 67 with at least $600,000, they would have to start saving when they would need to save much less if they start saving when they're 18 versus when they're 50. We talked about that. We talked about compound interest. So an 18-year-old would need to save approximately $12,245 every year to meet that goal. But if someone waited until they're age 50 to start saving, they would have to save $35,294 a year in order to reach that goal of 600,000. So that's why saving early is so important. All right. So let's go on to the very next slide. And once again, this is the compounding interest. So the earlier you start saving and investing, the greater the power of the compounding interest is going to be for you. That's going to be your interest earning. You're basically earning interest on interest. So it's not just the principal amount that you put in, but also that interest that's earning interest, and that's going to increase significantly. So when you look at this particular example, we'll assume once again that there's a goal to retire of at least 600,000 at the age of 67. Now, in this particular example, the 401k account you're using to save for retirement averages a 6% return. By factoring in compound interest, the amount you would need to save each year decreases dramatically. That's because you're earning interest on your principal amount and then earning interest on that increased number. So in an account with 6% returns, an 18-year-old would need to save $2,198 per year for 49 years instead of $12,245 without the compound interest, while a 50-year-old would need to save $21,266 instead of $35,294 without compound interest for 17 years. All right. So, of course, you can adjust your goals or use the power of time and interest to reach your savings goals. So let's take a look at that scenario to help us understand how compound interest works over time. All right, so we'll go to the next one. So this is Joan's retirement plan. So in this activity, we'll think about how compound interest works. She invested $100 into a retirement account. She then contributes $50 per month in an account that earns 10% interest and it compounds annually. So which chart best describes how her money will grow after 40 years? So Renee, which one do you think? Do you think it's going to be chart A or chart B?
Okay, so because there is compound interest involved, I'm guessing it would be chart A.
Mm-hmm. Yeah, and so for those of you that get the for those of you that get the participant guide, you will be able to see this a little clearer as well. But you are absolutely correct. Chart A, that's going to go up to the $300,000, where chart B, or close to 300,000, where chart B is only going up to roughly $30,000. All right. So yeah, the value of compounding interest is very important. You want to remember that compounding interest means that you earn interest on your interest, and then your money is actually going to earn more money. So people underestimate how much they can save over longer periods of time because of compounding interest. All right. So let's go to the next slide here. So these are different retirement income sources. So when you take a look at these particular retirement income sources, you see you have personal savings. So that's the amount that you have saved up for yourself personally. Hopefully you've been able to save some money on the side. Hopefully you have like a some sort of like a 3 to 6 month emergency plan that you can save for. But that's going to be important for you as well, just for emergency purposes. Really anything can happen, like a medical emergency, job loss, things like that. So you truly do want to have personal savings set aside. for retirement, but also for those emergency circumstances as well. Then you have employer sponsored retirement plans. Of course, we talked about the 401k. So the 401k, that's generally going to be the type of an account that most private companies are going to offer their employees. You also have the 403bs. That's going to be for a lot of your school and also hospital uh, jobs as well. Then you have Social Security. So that's going to be one of the benefits that many people are going to be able to take advantage of. We do know that there are some, you know, I believe it's in the 20, I know it's in the 2030s. I want to say I heard like 2032 or 2035, where a large portion of that fund, the Social Security fund, is supposed to be depleted just because the amount of money that's going towards Social Security, it's not as high as the amount of individuals that are taking from it. So it's really not something as it used to be. It's not really that like end all be all, where that's going to be a tried and true source of income for individuals in retirement. So that's why it's so important that we have these types of conversations so that people are setting aside enough money so that they're not reliant on Social Security just in case something were to happen and it's not available. Then you have investments. So, of course, investments, hopefully, they are going to grow over time. You know, a lot of people, they're going to choose to invest in different assets, real estate, stocks, bonds. There are some riskier investment classes, but there are rewards that are attached to those. Of course, the closer you get to retirement age, the less risky you want your asset diversification to be. So that's where maybe instead of having a high assets in stocks, maybe you start contributing to mutual funds, which is a pool of stock, and it lessens your risk burden. But then also maybe some some fixed asset classes where the interest rate is fixed. You don't have to worry about it fluctuating so much. You may earn a little bit less in it as interest rates fluctuate, but you don't really have to worry about your investment losing value. All right. And then there's some other sources of income as well. If you own a home and, you want to downsize, that may be your home equity. That could be an additional source of income for you as well. Receiving inheritances, gifts, money from friends and family, that can contribute as well. All right. So you definitely want to be aware of all those different income sources. All right. So now we get into some retirement saving strategies. All right. So let's get right into those. So you really want to develop a strategy to maximize your retirement income. You want to regularly set aside money for retirement. I know it says a little money, but you definitely want to set aside the amount that's specific for you. And I really strongly encourage you to create that retirement plan that we talked about earlier. That way, if you are on track to meet your retirement goals. And that way, if you're not, as your income starts to increase, you can set aside more funds and, you can hopefully catch up, right? Like if you didn't start so early in life, if you have that retirement plan set up and you know how much you'll need, then you can set aside more money as your income increases, hopefully, and as you are getting later on in life. All right. So saving is important. Investing is important as well, because in investing in assets, those are going to increase in value over time. When you think about real estate, your home, hopefully our home values are increasing. We think about, especially in the state of Michigan, over the last 10 years, 15 years, we came out of the Great Recession in 2008, and real estate values plummeted, right? But ever since then, they have been on the rebound. So many of our home values have increased, so we are able to take advantage of some of that home equity that we have. So that's just going to be another source, another retirement savings strategy as well when you think about that. All right. So let's go to the next slide here. We talked about types of plans, but we'll go over it again roughly. So, of course, these are all designed to help you accomplish your long-term savings goals. Retirement accounts, they allow you to save money as cash and or invest in stocks, bonds, mutual funds, and other investment vehicles. So when you look at these employer-based plans, you have the 401k and then the 403b. Like I said earlier, those are going to allow you to make pre-tax contributions to an investment account. The earnings will grow tax deferred. If you leave that particular job, your contributions and earnings are yours to keep. Every employer sponsored plan is different, so you want to research the rules and options that are pertinent to that particular plan. Um, and then, yeah, like I said before, you definitely want to take advantage of a match. If your employer does offer a match, that's free money that you're leaving on the table if you don't take advantage of that. Then you have defined benefit plans. These used to be very common, but they are often referred to as pensions. They provide workers with guaranteed benefits like monthly income. So once you retire, your particular benefit is going to be calculated according to years of service and earnings. And unfortunately, these plans are going away. It's not as commonplace as they used to be. So that's why it's important to have all of these different retirement strategies available to you to take advantage of. And then once again, like if your company doesn't offer a retirement plan, or even if they do, there are certain cases where you can start your own individual retirement account or an IRA. We talked about traditional IRAs and Roth IRAs. The traditional, you're going to put money in it pre-tax, so you're not taxed on that money until you withdraw it. With a Roth IRA, you will contribute after tax income, so you can withdraw money tax-free at retirement in that particular account. For a traditional IRA plan, you are able to contribute funds until the age of 72, as long as you are earning a taxable income. With a Roth IRA, there is no age limit, and you can contribute as long as you're earning a taxable income below a particular limit. So you want to make sure to research these limits as they change on an annual basis, right? So for both traditional and Roth IRAs, you can contribute up to $6,000 per year. And then if you are age 50 or older, your contributions can be as high as $7,000. So there's an additional $1,000 catch-up contribution. That's essentially what that's called. And there are tax penalties for withdrawing early. So you definitely want to have a good relationship with a financial advisor and or an accountant so they can review all of those different tax penalties. All right, so which plan is right for you? So a few factors that you want to consider when comparing plans. Does your employer match contributions? Are there any fees associated with the plan? Can you withdraw early in case of an emergency? Are withdrawals taxed when you deposit or when you withdraw? Will you be in a higher or lower tax bracket at retirement? And then are you saving for yourself, or do you want to leave a legacy for your family? Your children, your grandchildren, family members, things like that. So that's why it's so important that you find a reputable and knowledgeable financial planner, accountant, and also an attorney as you work through all of these different scenarios and you ask yourself all of these different questions, right? So essentially, you'll want to another factor that I wanted to mention. When you talk about fees, are there fees associated with the plan? A lot of times it's going to be very difficult to know if there are fees. You won't be able to see them on the surface. So that's why, once again, it's very important that you read the prospectus. A prospectus is essentially a guideline to a particular investment that you are going to participate with, right? Because that prospectus is going to give you insight into the fees that are associated with that plan. When you talk to different financial consultants, you definitely want to understand their fee structure, how they get paid. And you really want to work with one that's a fiduciary. A fiduciary is going to be one that's going to act in your best interest. And then, you think about churning. So something called churning is the constant buying and selling of stocks and mutual funds and investment vehicles of that nature. And that's how certain individuals get paid. So when you look at financial consultants or advisors fee structure, that's something that you want to ensure. Are they a fiduciary? So are they truly acting with your best interest in mind, as they're advising you on these different investment scenarios? And then, do they receive additional income by constantly buying and selling of stock? So you definitely want to take a look at that. Okay. A few other factors to consider, and this is really what I meant to talk about earlier. So you think about tax status and tax brackets. So if you invest in a traditional IRA or a 401k, you are essentially assuming that at retirement you will be in a lower tax bracket than you are now that you are working, right? So that's why you're investing with pre-tax funds. So if you invest with pre-tax funds, you are not being taxed on those funds right away. You're taxed on them at retirement. So, and that money is going to be added to your income, and you'll be taxed at that particular level. So, but if you invest in a Roth IRA, you essentially are considering the fact that you may fall in a higher tax bracket at retirement, and you want to pay the taxes now, so you don't have to worry about paying taxes at a later age or at a later date, and then pay a higher tax rate. So that's something that you want to think about as well. You think about matching contributions. We talked about that. You definitely want to see if your employer matches. Take advantage of that when you can. Um, Also, when you think about withdrawal limits, what are the withdrawal limits on a particular plan that you have? Does it make sense for you to withdraw money as a loan? If you withdraw money as a loan, it may take you a little bit longer to recoup, because it's good because you're paying yourself back, but those funds are essentially tied to retirement. So that's something that you want to think about. If you do have a need to withdraw from your plan earlier than retirement. And then next, so let's get into investments. All right. So you can invest directly in these particular options: the stocks, bonds, mutual funds. Stocks is essentially ownership in a company. So as a company does well financially, their share price can increase. If they don't do so well, the share price can decrease and you can lose money. So if you invest, like let's say you invest all of your retirement portfolio in one particular stock, that is essentially very risky, because you are tying all, you're tying the upside as well as the downside to one company. And, as you can tell by the current market, there's so many different factors that go into, can the share price increase? Can the share price decrease? So that is inherently very risky. When you look at bonds, you're basically lending money to corporations, government agencies, and you are guaranteed a fixed rate of interest for a specific amount of time. That's essentially how a bond works. When you look at a mutual fund, that is a pool of stock. So instead of just investing in one particular company, you're investing in sometimes hundreds or thousands of companies. So the upside risk is going to be lessened. I'm sorry, not the upside. Yeah, your upside return is going to be lessened, right? Because let's say you invest in Comerica stock, and Comerica stock, it increases, 30%. If you invest in a mutual fund, you're not going to be able to take advantage of that. But let's say our stock price decreases, then you won't have, it's not as risky to you, because your particular portfolio won't decrease that much. It won't decrease 30%, because you'll be diversified amongst different industries. Just as Renee said earlier, you might be invested in oil and gas, you might be invested in retail, you might be invested in consumer goods. There's just so many different industries that are available and that you can be invested in. So it just lessens that risk. And as you look at investing and you talk to a financial advisor or a consultant, they're going to go over your risk tolerance, right? So let's go right into that, right into risk management. So they're going to go right into your risk tolerance. Do you have a low risk tolerance, medium or high risk tolerance? Really, the younger you are, the higher your risk tolerance should be. And that's just because you have a longer time until you retire. So if the market were to go down, you have much more time that you can recoup a lot of those funds if there was a decrease in your portfolio. But the closer you get to retirement age, you should then look at lessening your risk because you don't have as much time to make up any downfalls in the economy or in the market overall, right? So you think about that risk reward, and also your risk tolerance. You think about those different factors when it comes down to creating a strategy for you. All right. So diversification, I believe, is really going to be key. So when you have a low risk portfolio, you're going to have a lower possibility for loss. You're still going to have some risk. And then you also have a lower possibility for return, just like I said. So you'll have more money in savings accounts than in investments, and then more investments in bonds than stocks. So if you do choose this strategy, you're less willing to accept risk or volatility. When you look at medium risk, you're going to face possibility for moderate returns and then also moderate possibility of losses. You may choose a medium risk portfolio if you are willing to and able to accept some risk or volatility. When you have the high risk is possibility for larger returns, but also larger possibility of losses. You may choose a high risk portfolio if you are willing and able to tolerate more risk or volatility. And then, like I said before, that should be a strategy for someone that's really going to be on the younger side as well, right? So as you assess these different strategies, you just want to keep all of that in mind as you consider your retirement savings goals. All right. So last but not least, you really just want to put your plan into action. You want to set your goals, develop your strategy, implement and maintain your goals, your plan, and then you really want to reflect. And this is really where it's going to be key to have that strategic advisor by your side, someone that's going to give you solid, reputable advice and something that you're going to be able to stick with. All right. So let's go next. So in summary, we reviewed all of the various strategies that are out there in order to consider when planning your retirement. We learned how to estimate your retirement expenses, identify savings and planning strategies that allow you to maximize your savings at any age, compare the types of retirement plans available for you, and then also set goals for your own retirement savings. All right, so I'm going to stop sharing, and then Renee, I wanted to get your final thoughts and then go from there.
Great. Thank you so much. That was a lot of good information. I like how you started the presentation and said that the key is comfort, making sure that you utilize the people and the resources that are available, whether it's the plan that's offered through your employer, maybe talking to some professionals at the bank, but really kind of interviewing people and getting a feel for what services they offer, and if your best interest, if they'll be running with what your best interest is, and moving with your goals in mind. And so I really like that as the starting point. Um, the key is to start. Don't put it
Yes.
off. Start
Yes.
start with something, whether it's um, $25 a month, or if you can do more, take advantage of the match, and talk to the people who are in place to assist. No matter where you are in your journey, if you've started or not, you've got to start. So take those steps to utilize those resources. So I really appreciate that, and I hope that that message resonates with the audience.
Absolutely, absolutely. Yeah, I mean, you're totally correct. It's you know, so we do a lot of these different types of financial education presentations, and one of them we do is on credit. And where a lot of people go wrong with credit is they don't open their mail. So it's kind of the same concept here. You don't want to bury your head in the sand and just say, I'll worry about it later. No, you need to start. And, we had a few different slides that reflect that. The earlier you start, then that's when your compound interest is going to take place. Your money will start making money for itself. But if you wait, now you have to set aside so much more, and then you may or may not reach your goals. So, we just have to take advantage of every opportunity we can to set ourselves up for a solid and healthy retirement, so we can enjoy those years.
Absolutely. Um, I want to let you have the last words. If there are any key points that you want our audience to take away from this, so much good information shared.
Thank you, thank you. Yeah, it really it comes back down to what you said earlier. Find someone that fits, that really you can work with, and don't be afraid to, as you're interviewing candidates, to be your financial advisor, your financial consultant, your investment banker, whoever it is. Don't be afraid to walk away because it's not a good fit. It may be a issue of, um, they might be being too pushy. They may not seem knowledgeable enough, in your opinion. You have to choose the person and the plan that's right for you. And then if you feel as if something isn't going right, hopefully they have good, constant communication with you. And then if they don't, maybe that's when you have to start looking somewhere else. But once again, it comes down to you really just have to do it. You have to start. And by starting, you're really getting there. If you have started already, I recommend that you utilize the resources in that participant guide to do that savings plan, so you know how much money you will need in retirement, and then you can start saving. You can start your savings journey, in your investing journey, with that goal in mind. So yeah, that's essentially what I like to leave with. And I work for Comerica. I would love if everyone that listens to this were to give Comerica an opportunity, but if not, totally fine. Start with your own banker, your own credit union, or your own financial resource plan, and I would recommend start there, see how it fits, and then if not, then start working with other institutions and see if it's a good fit for you.
Absolutely. Thank you. And don't get discouraged.
Yes.
It's never too late. Just start. Um, as mentioned earlier, and we've shown throughout the presentation, and I'm sure we're going to pop it up again, there is a survey. We would love to have you complete the survey, so that we can know how this information may be helpful to you, and also if there are some other topics you'd like us to cover. Additionally, if you send us or complete the survey and provide your email address, then we'll go ahead and send you a resource tool that you can use as you're putting together your retirement plan, and it'll help you as you're thinking about your future, and also help you in those conversations that you may need to have with your employment based plan or financial advisor. So we thank you for your time. We do appreciate Comerica Bank joining us today as part of this Money Sense series. Um, Also a part of Show Me the Money Day, again, designed to connect financial education and resources to the community. So thank you for joining us. We hope this information was helpful, and we'll see you next time. Take care.
Thank you.